Hello and welcome to another episode of the Eunice Ajim Show. My name is Eunice Ajim and I'm your host. And we are going through a series around investing in African tech startups. And the first question is, how do you choose the right company in which to invest in? But before I even get to that question, how do you find those companies? How do you find deal flow? I personally think there are definitely a couple of strategies, and we're going to look at both. If you are an angel investor, I have said this and I will say it again, the best way to go about it is by joining an angel syndicate, so they do all the hard work for you and you don't have to do it. You don't have to figure out a way to get that deal flow, because investing in your little cousin's business just because she's your little cousin and she's so hardworking might not be the best decision. Okay, but then if you are a VC, and I'll take very specific examples for myself, at Ajim Capital, we have two strategies. We have what we call the inbound strategy and we have an outbound strategy. In the last 1 year and a half, we have reviewed over 3,500 decks. That's a lot of companies. And it's because in our inbound strategy, we do a lot of marketing. There's a reason we create content. Like I've mentioned earlier, we have two clients. We have investors and we have founders. And the only way founders will know that you exist is by promoting yourself. So we create a lot of content around building a strong tech company, around fundraising, around like investing in Africa, like this particular video. And I think a lot of founders typically find us through LinkedIn or Twitter or just like social media in general. And then the more they research about us, they realize that we're a venture capital fund, and we've also made it very accessible for them to be able to pitch us. Literally everyone on social media says pitch us, but I think founders tend to like not go the right way about doing this, because they always end up sliding in my DMs or sending me an email, which is the wrong way to reach out to investors. At least to Ajim Capital, different investors have different ways to attract deal flow. For us, we recommend that you go through our website, click on the pitch us, and then send us an application. We review every single application, and in fact 80% of companies that we've invested to date were companies that were referred or like applied on our website, and we just enjoyed their companies and decided to invest. The other strategy is our outbound strategy. So typically this is when we collaborate with a lot of other investors. So we're pretty much connected to all the incubators, accelerator programs, angel syndication, all the other VCs that are out there. And we're always communicating with them and saying, if you have an amazing deal that you think match our thesis, please let us know. And we do the same to them. So we also send them some of our top performing companies when we're investing in a deal. We typically have a network of investors that we share that deal with. And that is a great way to attract the best companies, because guess what? A lot of these investors have already done a good amount of due diligence, and you just have to do your own part of due diligence. Another way that we look into our outbound strategy is like when we're always on the lookout for like accelerator programs, so like Dexter's, YC, 500 Global, Baobab Network, Founder Factory Africa, like all of these other programs that are really focused on investing in early stage companies, which is our targeted market. We're typically like attending the demo days. We're always in contact with them. So like check out their portfolio companies, Google for startups, and so many others. So that is how you find deal flow. And I think even as an angel investor or like as an individual investor, you can start using these different strategies to be able to like attract the deals that you're looking for. But if you're looking at investing through a venture capital fund, you don't have to do all of that, because we do the hard part for you. So how do you construct a portfolio? It pretty much brings us back to the fact that investing in startups is very risky, and typically over 90% of startups fail. And in the venture capital space, or at least in the startup ecosystem, us VCs, we have what we call the portfolio construction, which pretty much means that here are the number of companies that you have the intention of investing in, and here's your expectation or your future projections. Here's how much money you want to own into those companies, and here's how you plan on returning capital to your investors. I think when you want to go out and also start investing on your own, you have to have a formula. As of today, we have seen two formulas in the ecosystem that works. We have one that is called the power law, and then we have another one that is called the spray and pray. I personally think both models have the advantages and the disadvantages, and I think it's dependent on every single investor to know which one works best for them. If you are going through the power law, which the power law essentially means, or at least I won't say means, in my interpretation of the power law, is you're typically investing in a smaller set of companies. On average, you're looking at 20 to maybe like 30 companies, and you want to have as much equity into those companies. You have your initial capital deployed, and then you have what we call follow-on funding. So if you have a $10 million fund, you can say I'm allocating 40% into initial check sizes and then the remaining 60% into follow-on funding. And the idea of the power law is initially saying that I do the initial check size into a very small subset of companies, and then I look at my top performing companies and focus on doing follow-ons into those companies. I actually have a funny story, not a funny story, but like right now in this current market, as we're going through, I would say like a VC downturn or like challenging market environments, we have realized that a lot of VCs are not doing initial checks. They're doing a lot more follow-ons. And it's probably because they're pretty much finished deploying that capital. And now they're really just looking at the top performing portfolio companies, seeing the ones that are performing the best, and then like calling them. Literally, I was speaking to one of my portfolio companies a few days ago, and he was saying that like he had been trying to like raise a seed extension, and he pretty much gave up because the market was so crazy. And then out of nowhere, one of the seed investors just called him and said, hey, would you like to like have extra money? Because, he has to deploy the follow-on funding. And the reason why he will do that is, again, like he's just trying to get as much equity of this top performing company as he possibly can. So I actually encourage that founder to like go back to all of his investors and just say, hey, here's how we're doing. Will you guys be interested in doing follow-on into our current company? I actually think it's a great strategy if you're a founder fundraising right now and you already have some investors. I would highly recommend you go back to your investors that have a follow-on strategy, because not every investor have a follow-on strategy, and that leads us to our spray and pray. The spray and pray model, I think it has received a lot of critics by other investors in the past. But I personally think if you're an early stage investor, especially too in the African market where like it's still fairly early, there are a lot of options out there, I will actually recommend a spray and pray model, maybe with some moderation, and which is kind of what Ajim Capital is doing. So we don't plan on doing, typically a spray and pray model means that you invest in 100+ companies, which is a lot of companies to manage. But if you have the right team and the really like the right mindset, you can pull it off. I mean, a lot of the big companies that we know of today are all spray and pray model. I mean, YC is a spray and pray, 500 Global is a spray and pray, and a lot of early stage VCs actually use this model to be able to return their fund, which is go out there, invest in as many companies as you possibly can, with the hopes that the power law model says that you're pretty much putting a lot of your bet on the smaller subset of companies as they grow older. The spray and pray model says that if I'm investing in 100 companies, right, I know that even if 90% of my companies were to fail, there's still a high chance that I have 10 top performing companies. Whereas if you were doing a 25 company investment, if 90% of that fail, you're pretty much betting on like 2 to maybe 3 companies, which makes it a little bit more challenging, in my opinion, if those companies end up failing. So I think a little bit of like spray and pray with some moderation. So for us at Ajim Capital right now, we're targeting anything between 60 to 80 companies over the next 2 to 3 years. And I think that is an interesting strategy. How do you construct a portfolio? I gave you very detailed information. I didn't go into like much details on like, you also want to account for like how much ownership you want to own into these companies. When you're doing the spray and pray models, I would say typically you own about 1 to 3% per company. When you're doing a more the power law, you can typically expect to own anything between 5 to 15% of your top performing companies. Okay, that is it. Well, I hope you found this podcast episode somewhat interesting and useful, and I hope you have a blessed day and you are living your best version of the African dream. Thank you.